Goldstein.
Okay, I'm very happy to have on the Goldstein on Gelt Show, Joe Saul-Sehy, who is not only the co-host of the very, very popular Stacking Benjamins podcast, but he is also on the Money Tree podcast with me, which is a fantastic weekly show where we have really neat interviews and great discussions. He's also a former financial advisor, but I guess he got chased out of the business. Joe, how you doing?
I'm good. That's just a rumor, by the way.
I know. Actually, before we get into the questions, and for those of you who are longtime listeners of the Goldstein on Gelt Show, you know that Joe's been with me before. It's always a great time talking. Why did you leave the industry as a financial advisor and leave me behind?
I liked it. I liked being a financial advisor, but I had this mentor who was in the business, and one day we just got this email from him saying that he was leaving. And I was surprised that, because in the financial industry, especially with bigger firms, you don't tell people you're leaving. You take the client files and you go someplace else at midnight,
Right.
But instead of that, he was giving notice, and he said, I'm not going to be a financial advisor anymore. I'm not going to be in this business. He said, I'm young enough. There's other things that I want to do, and I want to go explore. And it was powerful. He actually said, I have other mountains I want to climb, which was the exact phrase. And he went and climbed Mount Everest twice. And so I realized that I own this financial business, and because mine was a franchise of the bigger business, I owned it. I could sell it. I could do the thing that I really wanted to do. So I thought I was going to go back to school and become a teacher at age 40. And while I was taking teaching classes, I started helping my friends with some of their public relations stuff. I wrote scripts for my friends that were financial people on television. I wrote their newsletters to clients, and I had more and more fun. And before I knew it, I have Stacking Benjamins was born, and being a teacher was on the back burner.
I got it. Well, you still teach, but you just do it in a different way, and frankly, you probably get paid a little bit more than being a school teacher.
That's the sad thing, yeah.
Yeah, okay. Well, that'll be politics for a different day. Actually, I do want to talk about politics a little bit today. Recently, the United Kingdom voted to quit the European Union. A lot of people don't even know what I mean when I say that, but the European Union has actually been around for decades, and Britain decided just to up and leave. They had a big referendum. Instantly, when the vote came out, the markets in the world crashed, and everyone got all upset, and the British pound crashed. What do you tell investors when big news, I don't mean little news, but this is big news, right? A major turmoil in like a big part of the world where some people could, hopefully find it on a map. What do you tell people to do when dramatic events like that occur?
Well, it's funny because people's gut reaction to an event like that is completely different than what my gut reaction is now. And I realize it's just because I trained myself over a number of years. And that training was whatever my initial gut reaction is, to look at the next domino, to think, okay, if this is going one way, then what's going to happen next? So if the market is going to fall, one of two things are going to happen. Either it's going to continue to fall and things are going to get so bad that nobody has any money, or, and much more likely, and what's happened all along throughout history, is the market rebounds. So if that's the case, there's only one of two things I want to do. I either, number one, want to do nothing, because a time of volatility is a time when the market, which is usually pretty unpredictable anyway, it's even more unpredictable. So if there's lots of volatility, I don't want to do trading in a time when I don't have any clear indicators. If I do trade, I want to be moving in, not out.
So this is a classic case of much, much easier said than done. And you and I are having a good time talking about it. But, as you remember, this isn't just one time, 2008 when Martians were coming down and lasering everyone on Earth and everything was going to be destroyed. And by that, I mean the banks were going down and the economy was really crappy. How could someone really see the light at the end of the tunnel when it really did look bad? It wasn't that people were making up stories. How do you train yourself to do that?
Well, it's funny because, I can even point to 2000, I think, which is an even better story, the market going down for a long time. Because I remember midway through and even at the end of the year 2000, talking about how this too shall pass. And as you remember, Doug, it didn't pass quickly, right? I mean, I remember at the end of 2001 then telling people, hey, hang in there. And they said, well, you said a year ago. That's what you said. And then in 2002, it was still going down. I remember we were on a family vacation in 2002. It went down even further. The bad news is you don't know the future. And I think the powerful thing is to remind yourself about the basics of economics, right? Economics, what you're really buying is you're buying companies. And at the end of the day, if companies continue to make money, the stock price over long periods of time, if we're talking about the stock market, will reflect the value of those companies. So sure, we might have a year, we might have even 2 years, like we just talked about, where the market keeps going down. But at some point, those companies have to continue to pay their workers. And if they pay their workers and they make a profit for the owner, that stock's going to be profitable, which means it's going to go up. So can we have a protracted downturn? Sure we can. But if we go back into into economics 101, I just need to keep buying that if I believe that companies are going to continue to be profitable.
We're talking with Joe Saul-Sehy, who is the host of the Stacking Benjamins podcast. He's also with me on the Money Tree podcast, a former financial advisor. He's been giving us a little wisdom in the beginning of our discussion today about how to deal with really, really crappy markets, but we've been talking about things that happened in the past. Let's use a little bit of a crystal ball. Not that I want you to predict who's going to win the election, but what should people be thinking as we're going into a very, very hotly contested U.S. election? What should people be thinking in terms of maintaining their portfolio in an intelligent way?
Well, I think two things, Doug. I think number one is that whenever there's an event where we know that we won't know the outcome until a particular day, we know that markets are going to be volatile around that, right? So that's the thing that we know. What we don't know is how economic policy is going to change after that event. We also know, looking at history, that unbelievably, because people actually think the opposite, financial markets have actually historically done a little better with Democrats in office, believe it or not, than they have with Republicans in office. So, but I still think that's all kind of irrelevant over the short run. Economic policy, whatever it is, will take some time to change, and over that longer time frame, we'll be able to have a much clearer view. But I think that trading, around election time, October, November, we should expect the markets to be a little more volatile. And we should also expect that the crystal ball is going to be pretty cloudy.
Okay, I'm trying to think if you just said something.
I sound like a candidate there, don't I? But seriously, here's the thing. We have a lot of people that say, well, so what do we expect the markets to do? And what I said was historically we have a lot of volatility, but really over the long period of time, I don't think it matters that much. Except for you can certainly make a case that economic policies matter, but those are longer things. Like, I think we're seeing, Janet Yellen not moving on interest rates. That's been a long, protracted thing that's happened. It's not day-to-day volatility.
Okay, let's take a scenario, because you were the first one to say Democrats on here, but I really don't want to try and predict who's going to win, but let's go for the model where the Democrats win and put someone in office, and let's say they go with more Bernie Sanders, socialist democracy, where they take a lot of money away from the rich and give it to the poor, which is I believe I've summarized the platform.
I'm sure that's how that's how Democrats believe it too.
Yeah, I've actually seen, because the hackers put out her emails, so we were able to see exactly what they're planning. But let's say that's what happened. That actually, and as a kind of free market capitalist, I see that as a potential fundamental flaw in the economy. So when you're talking about being positive over the long term and looking at growing earnings, well, really, if companies are giving their earnings away or taxed to death, it makes me nervous. And I think it's a legitimate feeling to be concerned about that because, there have been, it's not always 1 or 2 years the market goes down. Sometimes it's 1 or 2 decades. Look at what happened after, literally there were decades before World War II when the market was just nothing.
Yeah, but look at this. Look at these two candidates between Mr. Trump and Mrs. Clinton. Neither one of them really are a free market capitalist. So the difference between these two candidates, when you try to look at what their policy might be, isn't as big as it was, let's say, between President Obama and Governor Romney was. You definitely had a different thought process between the two of those guys. But Mr. Trump definitely is not a free market capitalist. I mean, he's said that.
Mm-hmm. Yeah, and I guess putting up walls and trade tariffs doesn't really sound free market.
Right.
Yeah, okay, I hear what you're saying. So maybe actually they'll just run on the joint ticket, the two of them together. And,
but I agree with people being afraid of, less free market capitalism. And clearly in this election, it looks like either candidate runs that way unless Gary Johnson sneaks in. But but I think that if we just look back at the history books, a lot of this happens every cycle, every election cycle. People get afraid. And then what happens over the next 4 years? Sure, some things happen and they affect the economy. But I can't think of that many times besides the election where fiscal policy racked the stock market violently outside of maybe Fed movement. Like I'm racking my brain for a time when the president said something, and I guess I have to go all the way back to Ronald Reagan, and some of the limited partnership platforms. Remember when that all changed? I mean, that was a time when the government didn't grandfather in any of these investments, and people that were holding them all of a sudden were holding stuff that was worth zero. Just overnight was worth zero. So I'm just trying to come up with a time where the politician said something that created huge volatility in a day.
I think we also have to remember that the president is not a king, and if he or she wants to make some real changes, it does require more consensus than just
right.
As Trump believes he can just sign executive orders and do whatever he wants.
Maybe that's why there's not huge volatility around something that a president has said.
I hear. Wow. Joe, I had no intention of getting into the politics today, but it was a lot more fun than, talking about the British who the heck cares, right? All right. Listen, we're just about out of time. So in the last few seconds, just tell us, how can people follow you and follow your work?
Well, besides being on the awesome Money Tree podcast with you, Mr. Goldstein, we have a podcast 3 days a week called Stacking Benjamins, which is a very light magazine-style show. Our goal is not to teach anything. Our goal is actually surround sound. We have... we have surround sound when we talk about other things like sports, or we talk about current events, or even politics. We have surround sound. But really, when it comes to money, there's a lot of gurus and a lot of teaching that happens, but not much where we're just talking about current events and money and really just kind of having some fun with it. So that's every Monday, Wednesday, Friday, wherever you get your podcast.
All right. And it is a great show, having actually been a guest on it in the past. It's a lot of fun. And despite what Joe says, you're sure to learn something about investing. All right, Joe, we will put links to all of that at the show notes of today's show at goldsteinongelt.com. Joe Saul-Sehy, thanks so much.
Thanks a lot, man.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.